Welcome you. You've given us a fascinating set of reports this time, all really zeroing in on China's economic performance in the first quarter of 2025. Our mission in this deep dive is to really try and cut through these numbers, especially that, well, unexpectedly strong GDP growth and the looming presence of U.S. tariffs.
Right.
To understand the core story and, what it means looking ahead, we're primarily diving into China's economy in Q1 2025. 5.4% GDP growth beats expectations from China Briefing, published just yesterday, April 16th.
And that phrase, beats expectations, is really the immediate headline, isn't it? The 5.4% growth, it genuinely surprised many.
Yeah.
It went beyond the 5.1% forecast in Cason's Economist survey and also edged out the Reuters poll predictions.
Exactly. And here's where it gets, well, really interesting.
Yep.
The engine driving this unexpected surge was a significant jump in exports.
That's right.
We saw a 6.9% year-on-year increase in yuan terms in the first quarter, with March alone showing a truly remarkable, 13.5% spike?
13.5%. Yeah,
Yeah.
that's huge. And what's fascinating here is that this robust overall performance wasn't isolated. The GDP figure itself reached RMB 31.8 trillion. That's around US $4.4 trillion,
Okay.
marking that 5.4% year-on-year increase. And it wasn't just one area propping things up.
Okay, so let's unpack this sector by sector then. We saw growth across the board, right? Agriculture, the primary sector, that was up 3.5%.
Mm-hmm.
Industry and construction, the secondary sector, showed a solid 5.9% increase. And the tertiary sector, services mostly, grew by a healthy 5.3%.
Right.
So while exports maybe grabbed the headlines, it's encouraging that domestic sectors like agriculture and services also contributed meaningfully. It suggests some internal resilience, maybe.
Absolutely. That's a good point. And looking at employment, the urban surveyed unemployment rate held pretty steady at 5.3% for the quarter.
Okay.
It's worth noting it did dip slightly to 5.2% in March, so perhaps signaling a positive trend there.
Mhm.
We also saw a rise in incomes. Average disposable income per capita reached RMB 12,179. That's a nominal increase of 5.5%.
So the slight difference there, that means after we factor in inflation, people's actual buying power increased a bit more than just the raw numbers suggest. Because you mentioned it translates to 5.6% in real terms.
Precisely, yes, after accounting for price factors. Now, turning our attention to manufacturing. This sector really demonstrated strong performance. It grew by 7.1%. And if you zoom in, equipment manufacturing saw an even more impressive 10.9% increase. High-tech manufacturing wasn't far behind either, 9.7% growth.
And the PMI?
Oh yeah, the manufacturing PMI in March, it was sitting above that 50-point expansion mark at 50.5. So that also indicated things were growing.
That's a really positive sign for the industrial side. And the services sector, also good momentum there. You said 5.3% expansion.
Yes, 5.3%.
Yeah.
And certain areas within services really stood out.
Like what?
Well, information transmission, software, and IT services saw a fantastic 10.3% increase. Leasing and business services also performed well, 10.2%, and transport, warehousing, and postal services grew by a solid 7.2%.
Now, let's talk about what people are actually buying. Retail sales showed what the report calls healthy growth. I saw that notable 7.7% jump in March specifically. That's right. The total value of retail sales for the quarter reached RMB 12.5 trillion, or about US $1.7 trillion. That's a 4.6% year-on-year increase overall.
And online, still growing strongly.
Yep. Online retail sales continued their growth, hitting RMB 3.6 trillion, that's US $493.2 billion, a 7.9% rise.
Okay, here's where it gets really interesting for me, the impact of that Old for New initiative. It seems to have really boosted sales in specific areas.
Absolutely, really looks like it. Sales of communication equipment shot up by nearly 27%.
27%.
Yeah, cultural and office supplies by over 21%, household appliances 19.3%, and furniture 18.1%. That initiative definitely appears to have provided a significant boost in those categories. However, it's important to maybe keep in mind the underlying cautious consumption trends, right? While retail sales saw growth, we are still seeing some deflationary pressures.
Exactly, that's the caveat. The CPI actually fell by 0.1% in the first quarter.
Right.
Although, if you exclude food and energy prices, it did increase slightly by 0.3%.
Okay, so that suggests that while people are spending, maybe they're still quite price conscious, still looking for deals.
That seems likely, yes.
Mm.
Now, shifting our focus a bit, let's look at investment. Fixed asset investment, FAI, that's spending on infrastructure, equipment, buildings.
Right.
It grew by 4.2% overall, reaching RMB 10.3 trillion. This would generally suggest a degree of business confidence.
Generally, yes, but while this overall figure suggests confidence, if we look deeper at where that investment is going, the property market struggles paint a more nuanced picture.
That's the big one. Real estate development investment saw a significant drop, down 9.9%.
Ouch. Nearly 10%.
Yeah. Looking at the breakdown, infrastructure investment grew by a decent 5.8%, and manufacturing investment was even stronger at 9.1%.
Okay, so manufacturing investment is strong.
Very strong. But that real estate figure really stands out as well, a significant drag on the overall investment picture.
What about high tech?
Ah, yes. What's also noteworthy is the strong FAI in high-tech industries. That was up 6.5% overall. And some subsectors saw remarkable growth, like information services at over 34%,
34%.
and aerospace and equipment manufacturing over 30%. This really indicates a strategic emphasis on those future-oriented sectors.
But there's a clear difference in where this investment is coming from, isn't there? State-owned enterprises saw their FAI grow by 6.5%,
No,
while private companies only saw a marginal increase, 0.4%.
just 0.4%, yeah.
And perhaps most concerningly, investment from foreign invested enterprises actually decreased by 9.5%.
Down 9.5.
This disparity, it raises an important question, I think, about investor confidence and the broader economic environment for different types of businesses operating in China.
It does indeed. Now, let's get to what was the primary driver of that surprising GDP growth, but also what is the major looming concern? Foreign trade.
Right. The double-edged sword.
Exactly. Overall, foreign trade saw a modest increase, 1.3%, reaching RMB 10.3 trillion. But the real story is in the details, as you said,
Exports surged,
by a strong 6.9%, while imports actually fell by 6%.
which, as the report points out, that suggests weak domestic demand, doesn't it?
It certainly points in that direction, yeah. And that March export figure we mentioned earlier, 13.5% growth, though particularly striking. It really highlights just how crucial exports were to the Q1 performance.
And private companies are leading this.
Interestingly, yes, private enterprises played a dominant role here, accounting for a record high 86.1% of all trading companies.
Wow. Okay. And what about trade partners?
Well, trade with traditional partners like the EU remained relatively steady, up 1.4%. Some key European economies like Germany, Spain, the UK showed good growth.
And the Belt and Road Initiative?
Seems to be yielding results. Trade with BRI partner countries grew faster than the overall market. Trade with ASEAN was up 7.1%, and with Central Asian countries by 6.9%.
Okay.
We're also observing a geographical trend. Central and western regions of China are increasingly contributing to trade growth, actually outpacing the more developed coastal areas.
Interesting shift. And in terms of products?
Well, exports and imports of equipment manufacturing products are up, which fits with the investment data, and also exports of those guoqiao or homegrown brands.
Oh, yes, guashao. For our listener, that essentially refers to trendy, often culturally inspired products from Chinese brands that are gaining popularity, right? Both at home and increasingly abroad.
Exactly. That's a good way to put it. The report even gives specific examples, like strong growth in sports equipment exports to the EU and cosmetics exports to Southeast Asia. It paints a picture of a diversifying export landscape and, increasingly competitive Chinese products.
But this is where the potential trouble lies. Those escalating U.S. tariffs.
Mm-hmm. The elephant in the room.
Right. While Q1 export figures look impressive, the report makes it clear that their sustainability is very much in doubt because of the tariffs announced between February and April.
Yeah. By April 9th, tariffs on many Chinese goods had reached a staggering 145%.
145%.
And China responded with 125% retaliatory tariffs on U.S. goods. It really highlights the delicate balancing act for China right now, celebrating this strong initial growth while bracing for potential headwinds.
There's been talk of a pre-tariff rush, right? The idea that exporters were trying to get goods out before the higher tariffs hit.
Yes, the report does touch on this. It notes that while it might have played some role, the share of U.S.-bound exports in Q1 2025 was actually quite similar to 2024 levels, around 13.5% of the total export value.
Okay, so it wasn't a massive U.S.-specific surge then?
It doesn't seem like it was the only factor, or even the dominant one, which indicates that while the U.S. remains a significant export market, it's the largest single country, second only to ASEAN overall, the Q1 growth wasn't solely dependent on this pre-tariff activity.
But the impact of the higher tariffs moving forward is still a major concern.
Absolutely, it has to be.
The report does highlight factors that might provide some resilience, though, like China's ongoing industrial transformation, the growing strength of those homegrown brands we talked about, and those expanding trade links with BRI countries. These could help cushion the impact, maybe, to some extent.
That's the hope, yes.
Yeah.
They could provide some buffer. And we're also seeing potential policy responses from Beijing aimed at stabilizing foreign trade.
Like what sort of things?
Well, measures to streamline customs procedures, support exports of new energy vehicles, NEVs, and expand cross-border e-commerce zones. These are all efforts to try and mitigate the negative effects.
It's interesting that the U.S. has granted temporary exemptions on some electronics, like computers, smartphones, semiconductors. That's a significant chunk of China's exports to the U.S., isn't it?
It represents about 22%, yeah. But the report emphasizes that these exemptions might not be permanent, they're temporary.
Right, so uncertainty remains there, too.
And while the possibility of a future trade agreement hasn't been entirely ruled out, the report suggests significant progress is unlikely without a direct meeting between leaders. So the near-term outlook.
For shipments to the U.S.
Definitely pointing towards a slowdown due to those increased costs.
But the overall picture seems to be, while these tariffs will undoubtedly have an impact, the combination of China's evolving economic strengths and potential policy responses might make the overall effect, and I'm quoting here, more manageable than initial reactions might suggest.
That seems to be the assessment, yes. Which brings us to the economic outlook and the potential for further policy support. Perhaps unsurprisingly, global banks have begun to revise their 2025 growth forecasts for China downwards. Institutions like UBS, CITI, Goldman Sachs, they've adjusted their predictions to the 3.4% to 4.2% range.
Now, it's important to remember that even these revised forecasts, they'd still represent relatively strong growth compared to many developed economies.
True, absolutely true.
However, they do fall below the Chinese government's own stated target of around 5% for 2025.
And this is where the expectation of an economic support package from the Chinese government becomes significant. Premier Li Qiang himself has called for stronger economic efforts and more proactive and impactful macroeconomic policies.
Right.
The upcoming Politburo meeting at the end of April is likely to place these economic challenges high on its agenda. We might see the formulation of specific support measures emerge from that.
And the hope is that these measures, if they're implemented effectively, could stimulate domestic demand, provide crucial support for businesses, and ultimately bolster confidence in the economy, helping to offset some of that downward pressure from the trade tensions.
So while the external pressures from the U.S. tariffs are substantial, the potential for timely and targeted interventions from Beijing offers a pathway towards stabilizing the economy and perhaps fostering more resilient long-term growth.
Okay. So, for you, the listener, the key takeaways from this deep dive are these. China's economy showed a surprisingly robust 5.4% growth in Q1 2025, primarily fueled by a strong surge in exports. However, this upward momentum faces a significant challenge from escalating U.S. tariffs, which are likely to negatively impact future export performance.
Right.
Looking ahead, we anticipate seeing policy responses from the Chinese government aimed at mitigating these effects and supporting continued economic growth. The initial strength was certainly unexpected, and its sustainability in the face of these global trade shifts remains a key question.
Yeah, and this raises a really important question for you to consider. Given these factors, the strong initial export growth, the impending impact of U.S. tariffs, and the anticipated policy responses from China, what do you believe is the most critical area for China to focus on to maintain its economic momentum amidst these global trade shifts? Is it prioritizing the strengthening of domestic consumption? Is it accelerating technological innovation to enhance its competitive edge? Or is it aggressively pursuing and cultivating new export markets beyond the United States?
Lots to think about there.
Yeah, definitely. And if this deep dive has sparked your curiosity, we strongly encourage you to explore the detailed regional trade data within the full report, or maybe investigate the specific impacts of these tariffs on different sectors of the economy.